Today we're diving into a topic that keeps many people awake at night, which is what happens when your steady stream of income suddenly ceases as soon as you retire. You see, over the last 15 years working with individuals and families on the subject of retirement planning, one of the biggest reasons that people continue to work longer than they should is because they're worried about how they'll be able to maintain their lifestyle the day that they stop working. You see, this is a very legitimate concern that people should have. I mean, you and your spouse might be used to living on $200,000 a year, and now you're entering the stage of retirement and those paychecks suddenly stop. This is why we have to ask ourselves the question, what is the plan for when this day arrives? Hopefully by the time you are ready to retire, you have run something called an income gap analysis. The analysis first starts with how much money you'll need on a monthly basis to be able to maintain your current standard of living. This should include all of your day-to-day living, plus all of the other luxury expenses like restaurants, traveling, birthday gifts, and even charitable giving. This number for you might be, say, $10,000 per month. But before you retire, you need to know this number. I've seen people be able to retire with $5,000 monthly lifestyles, and others need as high as $50,000 per month just to maintain their quality of life. Once you've established this number, then you have to ask yourself, what are our guaranteed sources of income that we have already established? For example, Social Security. How much is this going to give you and your spouse? Maybe between you and your spouse, it will add up to, say, $4,000 per month. But the reality is that you need $10,000 per month to be able to maintain your lifestyle. This gives you a $6,000 gap that you need to fulfill once you retire. This is why it is critical that you have to have an income bucket that you will utilize to be able to draw from during your retirement years. We are very big believers in going down what's called the 3-bucket approach. Bucket number 1 is your emergency bucket, which should normally consist of about 6 months of expenses. Here you should have 2 months inside a checking account more or less, and about 4 to 5 months sitting inside a money market account. Your second bucket is to be utilized to help you generate income for your retirement. Many people will put enough money in this bucket to help you generate an additional income every single month to cover that income gap that you're going to have missing once you stop working. This is where some individuals will use dividend-paying stocks or ETFs, others will use high-yield bonds, and some others will be using fixed and indexed annuities for their consistent flow of income. The most important thing is that you create this bucket that it will help you feed the checking account every single month and fill up the remaining income gap that you'll have once you stop working. Your third bucket will be your growth bucket, where you will put the remaining funds in a more growth-driven environment. And yes, this means that this portfolio will be having more volatility, but it will have a higher potential upside over time. I really hope you enjoyed this week's video. If you know anyone that needs assistance in structuring their overall retirement game plan, have them reach out. We're always here to help.